Welcome to Quickshots.
All right, welcome to Quickshots, ladies and gentlemen, where your favourite cousins get asked questions by you, our favourite listeners. And Alex, I'm going to hit you with this one straight up off the bat.
Here we go.
Simone wants to know, what yield should you aim for? Alex laughed at 3%. What yield should you aim for? I assume it varies from state to state. Read properties. Example, in Victoria, you would get a lower yield but higher growth, whereas Queensland, higher yield but lower growth. Is that right?
There was like 5 questions in there, so I feel like I've been jibbed. Let's start with the yield that I apparently laughed at. Simone, I don't recall, and I'm very sorry if I did. What yield should you aim for is purely based on like your appetite for risk and also your income. I had a great conversation yesterday with one of my clients, and he's got a very decent income. He's on about $200,000 a year. And he was asking me the same question. He said, what should I be aiming for? Because I really want to be cash flow neutral because I don't want to pay tax. But I'm always worried about losing my job tomorrow because he works in the construction industry. So I want them to be positive in case I lose my job. I want them to look after themselves. I'm like, mate, you can't have it all. But fair enough. In my opinion, I think today a pretty good yield is around that 4% mark. But if you are paying a lot of tax, a bit less than 4% is okay. You're going to start going into your negatively geared category. So, you are going to get some good tax benefits there. But remember, on a yield basis, that doesn't always, just a back of the envelope yield, it doesn't always include your depreciation. So once you factor in your depreciation, there might be a little bit more there that you can offset with your tax. And it might put you sort of in a little bit more of a neutral to positive scenario. So I reckon for me, cousin, I will ask you too, 4% is a pretty good number. If you can get higher than that, that's fine. You just want a little bit around your portfolio. If you've got a property in Victoria, your yield will be a bit lower, but then you might get one in Queensland, slightly higher. And then, of course, your South Australia and New South Wales or whatever. So have a little bit of a mixed bag, but it really depends on what you're comfortable with. The main thing is that you are in a high growth area. And you've got a relatively accessible rental property. So you're sort of in that median price where it's affordable for 90% of the population. And then I guess the next triple-barreled question there is in Vic you'd get a lower yield and higher growth. Yes, that's true. Queensland, higher yield, lower growth, not true. You will get a higher yield, but only just. But you will also get sensational growth. But obviously we can talk about far north Queensland versus out of Brisbane, not the same thing.
I think you do. Yeah, she's definitely right that you sacrifice yield to get better growth and vice versa. So it's about finding the right mix. And then if you're investing in non-residential assets like commercial property, which would have been probably the context that we discussed it.
Oh, well, thanks
and
for
in
telling
your defense,
me.
I think in your defense, you said 3% on a commercial property was low, and it's just because there's a little bit more risk with commercial property. So I think you should get a higher yield on commercial property where it's a little bit harder to replace tenants than with residential property. Generally replace a tenant very quickly with residential. Commercial, you've got to offer incentives and whatnot to attract them because they're just not as commonly around as in a residential
I didn't go anywhere
sense.
here with this commercial. There's nothing here that says commercial.
That's all right. Let's move on. What do you got for me?
Spewing. All right, let's go down here to Scotty. What is stamp duty? As in, like, I don't think he means like what is it. I think he means like what is it in a dollar cents per state, and why do we pay it? Well, Scott, we pay it because the government want everything for everything. Sorry, you go. You give your proper answer.
Yes. Well, we did. We got this one last week off the back of the fact that we talked about the New South Wales stamp duty changes. So actually, Scotty was my inspiration, much like you were on my run this week. Scotty was my inspiration for the Bulletproof blog this week. So go to bulletproofinvesting.com.au. You'll see a blog on there where I talk about stamp duty. And what I found out is that it actually originated all the way back in the 1850s as a tax that was charged by the government to formally recognise you as the owner of land. So back in the day, obviously there was not as sophisticated a system and technology at the time. So you'd have a lot of disputes about who was the owner of land. So the government would say, well, if you pay us a fee, we will stamp a piece of paper that says you are officially the owner of that block of land. So that's how it originated. These days, it is more of a tax, and I can't tell you what you get for it.
Full-blown revenue-making thing for states. That's what it is. That's the formal.
Correct. So it's a state-by-state or territory tax. It's roughly 3 to 5% of the property price. Most states and territories offer discounts and incentives for first-home buyers, pensioners, farmers, a few other categories of individuals. It differs state by state. I break it down by each state at the same
on your blog,
price point. Queensland's the cheapest. Queensland's the cheapest other than Canberra, which doesn't charge first-home buyers any stamp duty, up to $1 million, which is crazy. Victoria is the most expensive, and everywhere else sort of sits between, but roughly on a $940,000 purchase, which is the median house value in Australia today, you're going to be paying somewhere between $28,000 and $50,000 in stamp duty. It is a lot of money.
Well, I mean, considering now, the origins of stamp duty, like I understand paying someone in the government's their time to stamp your documents to certify ownership, but 51,000? No, buddy, no. So just that's kind of exposed how ridiculous it is. But anyway, I'm not in that world.
Adele wants to know, with tax time coming up, what can we claim? And is there anything still claimable from COVID?
Oh my
Ching
days.
ching.
Look, if you've been working, I'm not a tax person. Let's just put that out there right now. But
just so we're clear, she does pay her tax. If you're from the ATO, she acknowledges she's got to pay tax. She's just not qualified to talk about it.
We'll just see about that. Exactly. Look, if you've been working from home, you got to make sure that anything you've bought, you've got all of your receipts, and this is obviously what your company has not compensated you for. So put everything together. Make sure you've got a bit of a list of the money that you spent, any expenses that relate to your income. So this is quite interesting. It can also relate to perhaps your electricity bill. If you've worked from home 5 days a week and have done so for the whole of the last financial year, you could actually claim a percentage of your electricity. You've got to sit down and figure this out and go through it. It's obviously not going to be a one-size-fits-all. You've got to have your records. You've got to have your receipts, all of that jazz. And obviously you can't include anything that your employer has bought for you. But a few other things like cleaning costs for like your dedicated work area, your phone and internet expenses, your computer, obviously, if your work hasn't provided it, and then any other equipment. So I thought that was kind of interesting because I hadn't considered internet and electricity because those are things you had before COVID, right? But now you're sort of steaming through them. And using them more and maybe paying a little bit more as a result. So just make sure that you factor all that in at tax time.
3 days left as we record today to round out the tax year. So go and get the receipts.
And if I can say, it's the final 3 days to donate to a charity and get a tax deductible receipt. I have got one. If you're just looking for a way to park some money, melbournebasketbrigade.com.
There you go. Reach out to Alex. She's your girl if you need a tax deduction before the end of the year. Thanks for listening, guys. We love hearing from you. Send the questions through and have a great weekend.
Thanks for listening to another episode of The Double Shot with your favourite cousins, Alex and James Fitzgerald. If you've got a burning question or something we absolutely need to talk about on the pod, please write to us. Both of our emails are in the show notes. For little real estate tidbits and a little bit of banter, a lot of banter, you can follow us on the gram. Our handle is thedoubleshot.podcast. That, my friends, is thedoubleshot.podcast. Until next time, think of us when you sit back and sip your next double shot.